Hey, what's good, y'all? It's your boy Dylan, back at it again with another one. Y'all stay to the end of this video. Take notes. This is one of the most important videos on my channel. You're gonna know why, but let's get into it. Most traders think they need the perfect strategy, the perfect indicator, or the perfect entry, when in reality, none of those really matter, man, if you don't have one thing down first, and it's risk management. Today, I'm gonna be going over exactly why risk management is the foundation of every successful trader and why using a 1 to 2 risk to reward ratio or higher is the most powerful edge you can give yourself, even if you have a low win rate. What risk management really means? So, what is it? Man, it's simple. Risk management is the process of deciding how much you're willing to lose on a trade before you even enter it. It's all about controlling the downside so the upside can actually matter. If you're risking too much, like 10%, 20%, 50% of your account becomes just a time ticking bomb. You just ready to blow. You're gonna eventually blow your account. We've all been there. I hope you're not doing that currently, but if you are, pay attention to this video. One losing trade wipes you out. A bad day destroys your confidence. And a normal losing streak, man, that could end your trading career before it even starts. This is an example of not managing your risk properly. So y'all see how we got the wick. We have this zone right here, this demand zone. We got our signal to get in buys, right? It goes up a little bit. This would have been our stop loss or below the zone, whatever is your liking. But the stop loss should have been right here below the zone or below these wicks. So this was a 1 to 3 turned into a -8 to 3. You see what I'm saying? You don't want that. So you see how we came up a little bit in profit and we came right back down. It would have stopped me out or it would have stopped you out down here. Came up, you would have been just left hoping and wishing and guessing that it's gonna reverse and go your way and you're gonna win a trade, right? But no, look what happened. Every bounce fails. Bounce fail. Bounce fail. And then we get some sort of a bounce. We get a pullback. Ooh, we get over. Ooh, now you're confident, right? Get another one chop. What it do? Fail, 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 fail. And at this point, I hope you're not still holding. Some people do that. I've been there. I've been there. I held a trade to close. Imagine that on a trending day. I know how we've all been there. If a trader says he never held a trade thinking it will go his way eventually, he's probably lying or she's probably lying. So that's a bad example of managing your risk. This is a great example of managing your risk. So you see how we have this supply zone right here. We got our sell signal. We got some selling, we got some strong selling. We get in. It goes in our way and it comes up, stops us out, goes in our way, goes in our favor. This is a good example of managing your risk properly. And this what happens sometimes. Every trader goes through this. This happens to the best of us, man. It happens. But what matters is you managing your risk. You could have re-entered. So you can always know that. You can always re-enter if things like this happen. But you're managing your risk properly. But you see how we didn't respect our stop loss right here? We don't know what's going to happen at the end of the day. So we didn't respect our stop loss right here, right? We respect it right here, but it went in our favor. So some people would say, "Oh, well, I'm not going to do it because sometimes when it stops me out, it grabs my liquidity, it goes in my favor." Okay. I would say 6 times out of 10 times when you take these trades and you don't respect your stop loss, the trade will go against you. Just try it. Just try it. Oh, he doesn't know what he's talking about. Like, just try that. I'm telling you. So why do traders fail? Here's the truth. Traders don't fail because they're bad traders. They fail because they don't control their losses. You can have a 90%, 95% accuracy strategy, but if that one losing trade takes you back, your win rate really means nothing. So one loss could wipe out all of your wins. That's the importance of risk management. And that could look like, let's say once you take two winning trades and you get out wherever one trade you get out at $300 and another trade you get out at $900, and then another trade it just doesn't go against you and you hope and wish and you have no stop loss and you lose $2,000, you lose $3,000, you wiped out all of your wins. You see what I'm saying? You wasn't managing your risk. You get it? The market punishes traders who don't manage risk. You can't avoid losses, you can only manage them. So accept it, man. If you're a trader, you're going to lose. Like, just accept it. Do you want your wins to be real small or do you want them to be big to where it hinders you and you end up losing money? This is a game to where you're going to win and lose. You can't, we all want to win all the time, but that's not reality. You must understand that. You don't want a P&L curve looking like this. You don't want it just going consistently down. It's constantly going down. Okay, what is risk to reward? So let's talk about it, man. It's one of the simplest concepts in trading, and somehow the most ignored. Risk to reward or RR measures how much you risk versus how much you aim to make. So for an example, if you're risking $100 and making $100, your risk to reward is 1 to 1. If you're risking $100 to make $200, your risk to reward would be 1 to 2. If you're risking $100 to make $300, your risk to reward would be 1 to 3. RR is your protection. It forces your winners to be larger than your losers. And when your winners are bigger, you don't need to be right all of the time to make money. So here's an example of a 1 to 1. Here's an example of a 1 to 2. And here's an example of 1 to 3. So why is 1 to 2 RR or higher the ideal target for most traders? One, you could win less than half of your trades and still be profitable. If you only win 40% of your trades with a 1 to 2 RR, you're still going to grow your account over time. Two, it protects you during losing streaks. Everyone is going to take 3, 4, or 6 losing trades in a row. With a 1 to 2 RR, one clean win can erase 2 losses. Just keep that in mind. 2 wins can erase 4 losses. Just keep that in mind. Number 3, it removes emotional pressure. You no longer need to be right all of the time. You just need to win 1 or 2 good trades to recover from a bad day. Doesn't that just sound stress free? With the 1 to 1, you have to win every trade. In the moment, let's say you take 2 losses in a row, you have to win 2 trades. That's stressful. You know what I'm saying? I have to win 2 trades to break even, and then I have to make more. So I'm taking 3 steps back, 3 steps forward. Like rather than taking a step back and taking 1 step forward, but that 1 step is double my step back. You see what I'm saying? It's just better in the long run. So here's the math that proves it. So let's say I take 4 losses in a row and I take 2 wins in a row. I just wiped out those 4 losses with only 2 trades. That sounds amazing. And some of y'all trades are even going to be like you're aiming for 1 to 2. Some of y'all trades, or even most, I would say, depending on the volatility in the market, is going to be like 1 to 3, 1 to 4, 1 to 5. So imagine winning a 1 to 5 trade and you lose 3 trades in a row, still up 2 because you lost 3. You won 5 in total and you lost 3. You're still up 2. You see what I'm saying? You get it? So in that 1 to 5 trade. So even with twice as many losses as wins, you're still profitable. That's the power of risk to reward. Most beginners chase accuracy, professionals chase asymmetry, which means your upside is bigger than your downside. So how do we actually apply? Let's make this practical. Here's the simplest process. So step one, you decide how much you want to risk per trade. It's usually 1 to 5% or less. Two, you set your stop loss where the trade idea is invalidated. Three, you set your take profit at least 2 times the size of your stop loss. Four, adjust your position size to match your risk. If the trade can't offer you a minimum of 1 to 2, you simply don't take it. This rule alone can filter out half of your bad trades. Here's the long term benefits of all of this. When you stick to a 1 to 2 RR, you naturally become consistent. You're no longer gambling. You're no longer hoping for home runs every trade. You start trading like a risk manager first and a trader second. Small controlled losses, bigger intentional wins over hundreds of trades. This creates a predictable equity curve. That's how real traders survive long term in this game. So you want your equity curve to be uptrending. And you do that by managing your risk, staying disciplined, filtering out bad trades, only sticking to 1 to 2, 1 to 3 risk reward type trades. Your equity curve is going to look like this. But you must know how to trade though. But once you figure out what looks good, that comes with experience. But once you're experienced, once you get the time in and you get your experience up, you're gonna be in there, man. Your P&L curve is just gonna go nowhere but up. To wrap this up, man, risk management is the foundation of your entire trading career. Without it, you're lost. Without it, you're not gonna get anywhere, and that's a fact. 1 to 2 RR isn't just a suggestion, it's a cheat code that allows you to be profitable even when your win rate is low. If you master this, your trading changes forever. If you enjoyed this breakdown, hit the like button, subscribe, and drop a comment. It's your boy Dylan. I'm out.